This gentleman said earnings. Has the price of the stock, or a stock that you know of, changed when the earnings have remained the same? Historically, the answer is so. Earnings do not determine the price of a stock. Volume is sort of a representation of supply and demand. But really what these point and figure charts show you is supply and demand. And when they show you supply and demand, they show you price. Now another thing for you buy and hold people, Mattel, this is a chart on Mattel, went from 19.5 in late 1962 to $5 by December of '83. It rose up to 17 in June in '85, and by December in '86 it had fallen 50% back to $8 a share. So to make a long story short, a buy and hold investor who bought at the start of the chart over here at 15.5 would currently show a profit of just $1 per share after 7 years. Buy and hold. Ride it up, ride it down, ride it all around. It's not necessary. This is the type of analysis we'll be doing, a technical analysis of stocks using point and figure charts. Let's take a look at asset allocation in modern portfolio theory in terms of asset classes. Now, since the beginning of the stock market, various investments have been tracked. We have stocks, small company stocks, small capitalization, larger stocks, your blue chip stocks, long-term government bonds, treasury bills, and you have a copy of this in your materials. So what have we learned? We've learned that if you invested $1 back in 1925, that dollar today, well, in 1994, is worth almost $3,000. If that investment was made in small company stocks. So that small company stocks are the stocks that give you the highest return over time. But the volatility in them is greater. From here, you had a drop in the price and then an increase. But still, small company stocks, the highest return. Large company stocks are next. Long-term government bonds, treasury bills, and inflation. So $1 invested in treasury bills would be worth $12.19. Long-term government bonds, $25.86. Large company stocks, $810.54. And small company stocks, 2.5 times as much, $2,842.77. That's $1 invested. $10, of course, just multiply by 10. Now, what asset allocation does is it blends these various assets, there are other assets included in the group, so that your return might be somewhere in the middle. Because you're buying some of this and you're buying some of that, and you don't get the volatility, the up and down ride. Let's look at the market performance. Stock market, various investments. From 1946, 69 years of information in performance. Inflation, overall 3.1%, now 5.5%. In 1949, it was 18%. So inflation has gone up and down, but we're talking averages. Over 69 years, Treasury bills have returned 3.7%. 3.7% is barely over the inflation rate, and certainly not over the present rate, but this is an average. You say, well, Treasury bills are paying more now. We're talking about averages. Government bonds, 3.7%, intermediate 5.1%, corporate bonds 4.8%, large company stocks 10.2%, and small company stocks 12.2%. Would you feel better earning 5% in a 12% inflationary environment, or losing 1% after taxes in a 4% inflationary environment. Remember, inflation is the enemy. So what do most people say? Oh, I want to earn 5%, but inflation's 12%. So you're really losing more than if you lost 1% after taxes in a 4% inflationary environment. But you don't even factor in inflation. I'm going to buy this stock, I'm going to invest here, my stockbroker's going to tell me what to do. Don't listen to anybody. Become your own stockbroker. You don't need anybody's help. You can do it yourself. And we're going to show you how. Investing in stocks. Are you a long-term investor? Are you a speculator? Can you control your emotions? And what are the methods in investing in stock? Let's first talk about the methods. There are two primary methods. One is technical analysis, which is what we'll be talking about today, and the other is fundamental analysis. Most people don't know about technical analysis. Why? Because your stockbroker cannot sell you a stock based on technical analysis, because most people don't understand it. It's never been explained to them. So you get a call from your broker and they say, Motorola, great stock, and it's down now, and they just had a big contract, and you ought to buy it because it's going to go back up. What has he told you? He's giving you fundamental analysis. The fundamentals, the earnings, the sales, things of that nature. There's a joke about having dinner with a fundamental analyst. And it goes, I was having dinner with a fundamental analyst, and I dropped my knife, and it fell and stuck in his shoe. And I waited, and he didn't take it out of his shoe. So I asked him, why didn't you pull the knife out of your shoe? And he said, I was waiting for it to come back up. Fundamental analysis. Technical analysis has got nothing to do with any of that, except the technical analyst says everything about fundamental analysis is reflected in the price. So we know that if people value earnings, that will be in the price. And the price and the footprints of the price and of the fundamentals are shown on the price charts. And we're going to learn how to read those and make those. Controlling emotions. This is why most people lose money in the market. How many times have you bought a stock and thought, the stock is going down, I better sell it? Or how many times have you bought a stock and somebody has said, this is a great stock, it's on its way up, and you buy it? It's only the general population that buys stocks on the way up and sells stocks on the way down. The idea is to buy them before they go up and sell them when they're up. Buy on bad news, sell on good news. But even money managers can't control themselves. 80% of the money managers cannot beat the S&P 500. We'll talk about what it is. An analysis was done of that, and it's because they do not stick to their investment plan. And you will learn that you must have an investment plan before you place your order for a stock. You must know when you're going to go in, you must know when you're going to go out, you must know how much you're going to risk, and you must place your stop orders on every purchase. You do not call your broker or you have, oh yeah, buy me that, and then forget about it. And then he calls you, oh, that went up $3, you're down. You know when to sell, when to buy, where it's going to go. Totally not necessary. Long-term investing. Long-term investing, let's talk a little bit about mutual funds.